And I think I got up at one point to, just go to the bathroom, and it recorded the flushing sound in the background. Learn to use the mute button, I guess. Is it?
Oh, I think we have gone live. Going. So, look, Hugh, you want to announce?
Okay. All right. Things are winding down at CFA Boston. And on June 22nd, we have an ESG series, a practitioner panel on incorporating impact of ESG issues with Moody's ESG cross-sector methodology. And then we have on the 23rd is the CFA Boston's annual meeting, 75th annual meeting. Sri, do you have any announcements for Quantum University?
Yeah, so tomorrow I'm doing an invited talk at Premier. It's called AI and Risk Management in Finance. It's an introductory webinar. So it's 10 o'clock and it's free. So if you're interested, I'll put the link in the chat window. You can attend it. And the other announcement is we are in the middle of a summer school. So we've been doing these weekly lectures. So if you're interested in any of the topics on responsible AI, fairness, using machine learning, secure machine learning, also uncertainty quantification. So we have guest talks every week, Tuesdays at noon. So please sign up and we can send you an invite for that. And we also have a bunch of courses which we are doing for people who are interested in doing a full deep dive into many of these topics. So those are the two announcements I had.
Any other announcements?
So Sri, the free sessions are on Tuesdays?
Yes, it's Tuesday at 12 o'clock. Yeah.
Okay.
Okay. Boaz Hong Yang is the H. Talmadge Dobbs Jr. Chair of the Finance and Associate Professor of Finance at the J. Mac Robinson College of Business at Georgia State University. He's also the director of the FinTech lab at the Robinson's College, one of the first such labs associated with the business school in the nation, and he is he co-organized the GSU RFS FinTech conference, a leading FinTech conference that offers dual submission to the premier review of financial studies. Professor Yang's research has been published in leading journals, including the Journal of Finance, Journal of Financial Economics, Review of Financial Studies, and the Journal of Accounting Research, and the Management Science and Operations Research, and IEEE Computer and Advances in Mathematics. Professor Yang holds a PhD from Stanford and a PhD in mathematics from MIT. So take it away.
Okay, thank you very much for inviting me to present our work. Let me share my screen. Any feedback is very welcome. Can you see my screen?
Yes. Yep.
Okay, this work is joined with Chantal at GSU, my colleague, and Junbo Wang, who is here from Louisiana State University, and Wei Jiang from Columbia. So our topic is about man versus machine to man plus machine. And we focus on stock analysis. So let me start by motivating our work. So recently, AI has been a buzzword, right? We know people have been talking about the potential of AI replacing people, right? Some people sound the alarm, like Stephen Hawking and Elon Musk, like of them are worried about the future of AI. But on the other hand, other people also think AI can help people immensely. So what will be the future? We know this is a good example, like Gary Kasparov versus Deep Blue in 1997. That's a historical moment when the computer first beat a human champion, world champion in chess, highly intelligent activity of chess. But so everybody knows that Deep Blue beats Kasparov, but very little known is that after that, chess is actually, you probably know, chess is not dead, right? After that, chess become even more popular nowadays, and a lot of chess players actually use the help of computers. Actually, there are matches of so-called centaur chess players where people combine their intelligence with computers aid and try to compete together. So that's what motivates us to our study. We focus on stock analysis, the application of AI in stock analysis, because we are studying the financial economics. So what are the main research questions? First of all, we are interested in whether can machine beat human analysts? Can machine be very helpful? On the other hand, even if machine can beat humans, it doesn't mean humans are totally useless, right? They may still have advantages in some situations, at some times. So we understand when humans still have advantages in the age of AI. And finally, our goal should not be just replacing human with machines. So we want to combine human and machines and see what's the best way to combine them and how will that help us in general. So that's a broad roadmap of our paper. So we try to connect to the growing literature in several strands. First of all, there's a huge literature studying economics and finance, studying the competition and the threat to human workers by machines, robots, and AI. Right. The general consensus, I mean, a lot of from the theme is that machines and robots tend to compete with people for high-skilled jobs. Right. They can diminish the share of high-skilled job. I mean, low-skilled job and drive people toward a high-skilled job. But even in high-skilled jobs, there are also threats now. So that's a present threat. On the other hand, the impact of big data and AI in the financial industry has been studied by many papers. For example, this is the incomplete list. They study applications in mutual fund investment, like asset management industry, analysts, as well as robo advising. So there are many applications. And finally, recently in the finance literature, there is a growing trend of using machine learning tools to study financial problems. And this is already growing to be a big literature, and here is also an incomplete list. Our paper differs from this, is that the main difference is that first of all, we build an AI model, right, to compare the AI model directly with humans to identify the relative advantages of human and machines. And furthermore, we build a hybrid model that combines AI and human. That way we can further evaluate the remaining advantage of humans in the age of AI. So feel free to ask questions during my presentation. Now, here is a sample of the data sample. I will go through this quickly. The main sample we use consists of the analyst target forecast, the price forecast from IBES. Our sample period from 1996 to 2016. That's from the start of IBES. And we also match with CRISP and the CompuStat to get prices and accounting information. So the final sample will be it's about 680,000 analyst target price forecast on more than 6,000 firms. So why do we focus on price forecast instead of earnings forecast or recommendation? Well, first of all, price forecast is It's a major thing analysts do. Most of the analysts do. It's the primary job task. Earnings, of course, is also another major task of analysts, but earnings are subject to manipulation by managers, right? We know that their managers try to beat or meet analyst forecast consensus. So that way, there is an endogeneity involved when you try to predict earnings ratio, because that can be itself influenced by forecast. So that way we on the other hand, the target prices are market defined by market, so they are much less manipulable. And finally, the target price is also a more clearer performance metric than recommendations, because it's harder to evaluate recommendations whether it's good or not. But we can measure whether forecast is accurate or not by comparing with the real prices. Okay, so how do we build our AI analysts? First of all, we start with the information set for the AI. We know that we should only include the public information, because analysts nowadays are not expected to have private information after regulation FD in 2000. So ideally, we should include all publicly available data up to a time t. However, practically, we cannot do that, right? We can only include the easily accessible data. So for this purpose, we include all the a lot of firm and industry information from CRISP and CompuStat, the textual information from first SEC filings, as well as macro data. So when we do our training at each time t, when a human analyst make a forecast, we also let our AI model make a forecast, right? So it's kind of like a run head-to-head with the human analyst. We use the data in the past 5 years to train our machine learning model. For that, because of that, our first prediction will be in 2001. We need 5 years of data. And we, after we train the model in the past 5 years, we feed the data up to time t into the model to make the prediction at time t. So we are only using past data to predict the future. And more importantly, we do not include analytic forecasts in our predicted variables. So that way, we only rely on the publicly available firm data. So we can compare the performance of AI with humans without contaminating the AI forecast with analytic forecast.
Can I ask, what was the frequency of the data that you're using?
It depends. A lot of accounting data is just quarterly. Stock prices are more frequent, but we convert everything into quarterly for convenience.
Okay, thank you.
Welcome. Okay, so here are some more details about the data we use. For firm characteristics, we use stock price, past returns, past earnings, and a lot of like more than 30 firm characteristics, like book to market ratio, assets growth, a lot of characteristics known to predict stock prices by the literature. You can find the complete list in our paper. By the way, I should send you the paper link. Jimbo, maybe you can send the paper link in the chat box in case people want to see the paper. So we have a number of industry variables. So including like the computation measure from 10K, this is a textual variable counting the computation related word in 10K disclosure by firms. And we also have another textual measure of product market computation, basically. This measures changes in rival firms' product relative to the product in the focal firm using textual analysis by Jerry Holberg and other co-authors. We have include industry dummies at the Pharma French 48 industries level, industry size, and industry average earnings in the past. We include a bunch of macro variables, including production index, CPI, oil price, 3 months and 10-year treasury rate, and credit spread, BA to AAA credit spread. And for textual variables, we have two kind of variables. One is the sentiment variables based on dictionaries, right, from Lofgren and McDonald, which is a well-known list of dictionaries, positive and negative words in the financial context. We measure the positive and negative sentiment of SEC filings, including 10K, 8K, and 10Qs. Those are a bunch of variables. And we also include a number of machine learning-based sentiment variables. This is from a paper by one of my co-author and other people. And they use a machine learning approach to capture the sentiment related to future performance, right? So basically they capture sentiment words that are close, modifying future performance rather than sentiment about other things. So that's more than 100 variables in total we have to train the model. So for the model, we use first of all, for the AI model, we chose in the end an ensemble of 3 different models: random forest, gradient boosting. I don't know whether you're familiar with that, but both of them are themselves ensemble models of decision tree models, right? And we also include a neural network model, long short-term memory neural networks. This is a specialized neural network. It's especially tailored to time series predictions. So it's useful for financial data, particularly. For comparison, we also examine a number of other models to see the performance of different models, including like the linear and quasi-linear models. For the man plus machine model, right? So after we build the AI model, we can also build the AI plus human model, hybrid model. We use the same machine learning model, but when we do the machine learning, we include all the previous variables, but and the analyst forecast, the average analyst forecast over the past 90 days, and the mean square error of analyst forecast over the past 90 days. In other words, we incorporate analyst forecast information into the machine learning model to get a man plus machine hybrid model.
May I ask a question?
Yeah, go ahead.
You said mean square error. Do you separate the bias from the noise?
In the current version, we do not. Yeah, but we are planning. Yeah, we are planning to measure analyst bias. I guess that's what you mean, right? Analysts may have a bias in their predictions. Is that what you mean?
I asked the question in part because I'm speculating that analysts have a well-known bias in favor of optimism.
Yes. Yeah, we are aware of that, and we are in the next revision. We plan to adjust for the bias of analysts.
Thank you.
You're welcome. Okay, so when we after we build the model, we can compare human and machines, right? There are a number of potential factors that can affect the relative performance of human with machines. For example, information transparency, whether the firm had a lot of information available, public information available, as proxied by Heard illiquidity measure, the stock price volatility, and the firm size. So the conjecture is that more transparent firms are easier to predict by machines, right? And the volume of information, as proxied by the number of 8K reports each year. The conjecture is that the larger the volume, the easier it is for computers to process, but the harder it is for humans to process the information. Another one is the nature of the information, like intangible information. This is proxied by 3 variables: in the literature. One is 1 minus the ratio of fixed assets to assets. The other two are organization capital and knowledge capital. Basically, these are R&D and SG&E scaled by assets, right? As used in the paper by Evans et al. So our conjecture is that if the firm has a lot of intangible information, it's harder for machine to grasp, to evaluate the firm, because those information is not contained in the public statement, right? It requires some human intelligence to decode. And finally, the analyst the information environment measure, like for example, how many days to the target date. The shorter the distance to the target date, the more accurate humans might be. The size of the brokerage firm, as measured by the number of analysts, the larger the size, the analyst will have more resources, and hence may make more accurate forecasts. And finally, the number of all previous predictions by analysts that may provide more information to the analysts as well. Some other variables include shareholder base. So the number of institutional owners of the firm, that may be informative of how much information is there available in the market, right? The more institutional owners there, the more mutual fund, hedge fund there, then they may have more information available for the firm. It could be also be information asymmetry, so could be either way. And the macro and the industry information environment as measured by industry distress. So whether the industry of the firm is in a distress state, as measured by the bottom quintile of industry stock return. This has been shown in the literature that industry distress do predict the future returns. So this is the important variable, and also whether there's a time trend. We know that AI has been increasingly applied in the industry, financial industry. So that can shift the balance between human and machines in our test, because humans will have access to AIs as well over time.
I'm going to ask a question which came in online. So Yusuf from Sun Life was asking, don't you also look at analyst forecasts for futures, which should be available at the time of prediction, because it will not cause look-ahead bias?
We are testing the model with the future forecast. So it's not we only training the model with the past data, but when we test the model performance, we only do the future predictions.
Okay. Thank you.
Thanks. Yeah, it's not all the predictions are out of sample, not in sample. Okay, so finally, the analyst machine learning skill and availability of data to analysts also may matter. For this, we use two variables to proxy. One is the brokerage firm of use of AI, hiring of AI-related human employees, right? So basically, this is available from Burning Glass, which is a database of all employment data, like job postings in the US. So this can measure whether the brokerage firm hired a lot of AI researchers that can help the analyst. And the other data is whether the analyst may have access to alternative data, including such as like a satellite image of parking lots, right? Which you guys probably are very aware, right? People use parking lots counts to predict earnings and prices. So these data might be affecting the efficacy of analyst forecast as well. Okay, so when we start, we basically make the following model. So we use a number of variables, xi, t minus, right? Those are the variables available before time t, and to make a prediction f ai it. So the f is the model, machine learning model, and we want to minimize the error between the machine learning forecast and the future price, right? log price. So minimize this error with our machine learning model. And if AI, we define AI to beat human if the forecast of AI is has a smaller error than the human forecast in the next period, and vice versa.
Can I ask another question?
Yes.
So you're comparing the AI to individuals by individuals and then summarizing, or are you comparing AI to a collection of individuals as they might average their forecasts?
Yeah, we're comparing to individuals. So for each individual, we let the AI make a forecast at exactly the same time point, using all the available information at that time point, and
Okay.
compare that with that individual. Thank you. So the first question is whether AI can outperform most humans, right? Recall that what we show here is a lower bound of AI, because our AI may not be the best AI available in the industry, right? We are limited by the data we have and the model and the computing technology we have. But at least it's the first attempt at this question. So in each year, we compare AI with all the analysts and compare the percentage of AIs beating human. Right? The percentage, I see this 50% can be viewed as the benchmark, right? If and it's the blue line, the solid blue line is a percentage of AI beating human each year. And you can see that in most years, AI beat human more than 50% of the time. On average, the beat ratio is about 53%. So AI pretty much already beat most humans in most years. And these dashed lines are confidence intervals. So it's pretty confident. We're confident about the beat ratio. The red line is a linear trend. The best linear trend approximating this curve. This is trending down. This is an interesting finding because it indicates that humans are getting better relative to our AI model over time. And what's the interpretation? I mean, we conjecture it's because humans are increasingly having access to AI, machine learning, and big data, right? So the analysts in the more recent period have access to those technologies themselves. So that's why our AI model wouldn't perform as well compared to them.
Is this, by the way, is this real data or is this made up?
It's real data.
Wow, that's a powerful trend.
Yeah, we are surprised too, but it's kind of interesting. Also, we see that in some years the AI did badly, right? Like you see these dips. The dips can tend to coincide with a financial recession. For example, it's 2002, 2003, and 2008 to 2010, and here it's a double dip thing in 2013. So we find that in recession times, AI tend to perform worse. Why is that? I think it's maybe because of regime break, right? The model that are applicable to regular times may not apply to recession times. And also the data in recession times may be more scarce, data. It's harder to predict. But we will welcome any thought about this. If you have any suggestions about improving AI performance in those periods, it will be very welcome. Okay, now let me look at the different AI models, different machine learning models, and give you some intuition about how they perform. The first model is OLS, linear regression, the good old OLS. And it's not surprising, it doesn't do so well. It only beat 19% of analysts. Right? So it's not so good. If we extend it a little bit to elastic net regression, it is basically a combination of lasso and ridge that allow you to include a lot of variables with dimension reduction, right? It's automatically selecting a number of variables. This is better. It's a quasi-linear machine learning model. It's better than OLS, but it only beats 23%. It's a little better, but not too much. And another model is a support vector regression. It's also pretty popular in recent years. It's also a quasi-linear machine learning model that focuses on the marginal point that separate the predictions. So this will allow dimension reduction as well, right? When you have a lot of variables, you can use support vector regression. In this case, it's a little better. It's only 20, but it's still only 27%. The real increase in performance occur when we go to the more sophisticated models, like a long short-term memory model, neural network model, which specifically handles time series prediction using neural network. It beat more than 50% already. Random forest, this capture very complex interactions between the variables. It's a bit more than 51%, and gradient boosting is another way to aggregate a decision trees sequentially. It's kind of like the Newton method, right? You approximate the prediction sequentially using a bunch of decision trees. It does even better. It's 52%. In the end, because these three models perform similarly, we combine them in an ensemble model. So it's simply just the average prediction of the three models. And this performs the best. It's about 54% bit ratio relative to human.
How did you create the ensemble model? I mean,
Yeah.
in some ways, we are looking at 50, 51, 52, which are more or less similar, right? Now, are we gaining any new information, or is there just that a particular combination of these three models gave a better result?
So yeah, that's a good question. First of all, because they are similar, right? We conjecture combining them can improve, right? Typically, when you combine like the top models, right? And also these models are different, right? They capture different aspects of the data. Like this capture time series, and the random forest and gradient boosting capture different interactions. So that's why we believe combining them actually give you more information. And the way we combine is just calculating the simple average. We also try the machine learning way of combining them. Try to combine them with a simple neural network, but it doesn't do better actually. So in it, the simple average of these three, the prediction of the three models actually is better than any of them.
Mm-hmm. And did we look at how these perform in stressed regimes?
Oh, that's a good question. We didn't do that. We can decompose you're suggesting decompose across different years, right? The performance. Yeah, we can try that. Yeah, thanks.
And also, I mean, in some ways, can we also quantify the amount of overfitting, considering, and this was daily data, right?
These are quarterly data.
Quarterly data, okay.
Yeah.
Also, if we can look at more granular data to see if the algorithms are actually learning versus just fitting. It'll be interesting to see.
Yeah, but we are using out of sample prediction, right? So if there is overfitting, it wouldn't do well, right? In out of sample. So, but I see what you're suggesting. If you have a higher frequency data, right? You could generate a better training, maybe. Is that what you're saying?
Yeah, I think yeah. So I think quarterly, maybe two cores.
Okay.
To kind of look at.
Okay.
Yeah, just my thoughts. Yeah.
Okay, we'll think more about that.
Thanks.
Thanks. Okay, so we also look at whether the AI analyst forecast is persistent. So for this, we compare the AI with analysts that are basically at the above median performance and below median performance, and see whether AI continue to perform better or worse than the analyst. And in the second attempt, we actually track the analysts that have performed well in the past number of years, like for example, past 5 years. The analysts are consistently above the median. So this analysts are likely to be one of the best analysts, and see how AI stack against the analyst. And turns out, I mean, I'll go to focus on the second test. Even for the analysts that are among the top half in the past 5 years, AI can still beat 49% of them. So AI still perform comfortably against them. And for analysts that are worse, of course, AI beat even much more. So overall, we see that AI performance is relatively persistent. It's not like very fluctuating a lot. And as you guys are, I mean, professionals, you might be interested in whether you can make money out of it, right? So here is a portfolio trading strategy following the AI recommendations. So we construct a portfolio based on the relative forecast between machines and man. Each month we gather all the predictions by the human and the corresponding AI. And for each prediction, if the AI predicts a higher price, then we buy. And if AI predicts lower price than a human, we sell. This is a long-short portfolio. And of course, there may be mixed signals because there are many analytic forecasts. Some forecasts may be buy, some forecasts may be sell. So we aggregate all of them. If the more buy signals than sell signals, then we buy the stock, and otherwise we sell the stock. And each stock will be held or shorted for 1 month or until the signal reverse. So every month we rebalance the portfolio. And we calculate the return on alphas using 3-factor, 4-factor, and 5 and 6-factor alphas. So here are the results. With our long-short portfolio following AI and versus human, the raw return is actually pretty large. It's 0.91% every month. So it's about 10% per year. And considering the portfolio, we include the portfolio forecast information in the past 30 days, 60 days, or up to 1 year, the performance is similar. And after you control for risk factors, like farmer French 3 factors, 4 factors, up to 6 factors, the returns still remain. So this strategy is profitable. And if you look at where the return come from, is most of the return come from the long lag. So that means when the AI make a favorable forecast, you buy the stock relative to sell the stock, then the return is high. It's actually higher than the overall result. And for the short lag, when the AI makes a lower forecast than the humans, you sell the stock, there's some return, but it's insignificant. So we conclude that most of the return come from the long lag. Okay, so now we look at the performance of the hybrid model when we combine man and the machine. First of all, man plus machine will outperform 57% of all human analysts. So it's better than machine alone, which was 53%. And furthermore, man plus machine also beat AI forecast. They beat 56% of all AI plain machine forecasts. And you can see this. This is the man plus machine versus man. It's higher, right? The average is higher than before, and also the trend is more stable because now you are incorporating the human prediction. And on the other hand, if you compare man plus machine versus plain machine, there's an increasing trend. Again, this may be because humans are getting better in more recent eras. So when you incorporate a human into your model, you can beat machines even more. Now we look at how what can how do we understand the relative advantage of humans versus machine? Let me go to the table directly. So first of all, the dependent variable is a human beat machine, the indicator variable, right? And we have a bunch of independent variables I discussed before that may be related to how human or machine perform relative to each other. And we find that first of all, like more illiquid stocks and smaller stocks tend humans tend to perform better. Right? The positive coefficient suggests that humans perform better. So that's consistent with the idea that humans are better at more informationally opaque firms. And when the firm has more information available, humans do worse. These different specifications include different fixed effects, like year fixed effect and firm fixed effect. So machines are better with a lot of data. Humans are better at intangible assets, right? When the firm assets are more intangible, humans are better. Humans are also better when they're closer to the targeted date.
I'm sorry, did you say, what are the different columns?
The columns, each column is a different specification with a different fixed effect in the regression. And here we have, for example, here no year fixed effect, here no firm fixed effect. In the end, we have a fixed year fixed effect and a firm fixed effect. That's the most restrictive specification. You can focus more on this. Basically.
Okay, all right.
Okay, so the number of analysts, basically the size of the firm also matters. The larger the firm is, the analysts perform better because they have more resources. And finally, the industry's distress also matter. When the industry is in distress, humans do better than machines. But it's consistent with our finding that in distress, machines do not do that well because of the model change or lack of data. This is another test using the forecast error spread between the human or machine, between the human and the machine forecast error. And the results are similar. Basically, this test when a human forecast is more accurate than machines, and results are very similar to the previous table. So I will skip this. And next we will look at how the hybrid model, man plus machine, stack against man and machine alone. This is the man plus machine versus machine. These two columns, and these two columns are man plus machine versus man. And you can see some similar patterns before. For example, like more illiquid firms. For more illiquid firms, man plus machine can beat machine because humans can add more value here, right? Humans can process more illiquid firms better or more intangible firms better. So broadly, you have similar results as before, but what's remarkable is here is that humans have relative advantages. I mean, incremental values, even when they are combined with machines. So that's the main message of our paper. Combining human and machine does yield non-trivial value. Here is the incremental value of man plus machine when you measure the value by the decrease of forecast error, right? Because the machines will have a forecast error, and when you combine human and machine, the forecast error will decrease. When they will decrease, for example, when the firms are more intangible or less liquid. What's interesting here is that actually when you combine the man and machine, the number of 8K reports no longer matter. That means when the firm has more information available, man plus machine doesn't do worse than machines. And here also here is another interesting finding, like the firm size also do not matter anymore. That suggests that firm size used to matter for analysts. Analysts in a larger firm perform better, right? But now they don't. We suspect it's because in the advantage mostly come from AI models anyway, right? So when you combine analysts with AI, then the advantage disappears. No? And our final test is the event study. We try to understand when the human analysts receive big data and AI help, do they perform better? So we have satellite data coverage from this paper, Katona et al. They provide a list of firms and the start of coverage date of this alternative data for these firms. We'll compare the performance spread between analysts and AI with a control sample, right? Because these firms will have alternative data available starting from a certain date. Other firms don't. So that's a natural experiment to see if when the firms have alternative data coverage starting, switched on, do our analysts perform better after that compared to other firms? And in addition to that, we also have another proxy of AI hiring from Burning Glass, following this paper by Babina et al. So we have two hypotheses. The first one is that after the big data become available, analysts cover the treated firm will perform better relative to AI compared to other firms. And the second is that such improvement will be stronger if the analysts work in brokerage firms with AI capabilities. Because the AI capability can strengthen, can even further promote the advantage of big data.
I'm sorry, how do we define that the human analyst is actually using AI again?
The human analyst is actually using AI? You mean?
Using AI models for decision making, or using it as a decision support system, or
yeah, that's a good question. We don't directly observe that. So here we are just indirectly measuring that by the AI hiring of the brokerage firm. So if the brokerage firm hire more AI researchers, we assume that, I mean, their research will be available to the analyst. So okay. It's very hard to directly see that. If you have any suggestion about such data, that would be very welcome.
Well, that's a great one, right? Like, if there is an increasing trend of hiring of Python developers or people using AI models, or even if they have research staff with people with AI experience, then probably there is some kind of exposure towards those kinds of techniques.
Yes.
And also it could be the frequency of turnover of their investments also.
Frequency of what turnover? I mean,
turnover in investments, like, what kind of strategies are they using? It could potentially shed some light.
You mean strategy, investment strategies?
Yes.
Or, okay.
Their holdings, like, if their holdings are changing, so it could be data driven in some ways.
I see. So for that, we have to look at the brokerage firms who also have a asset management branch, right? Okay. Thanks for the suggestion. We can think about that.
Question that's related to Shree's comments. So, I mean, a strong result is if you can show that this is regime independent. I don't know if that's what you're going for, because maybe the results are just a result of the period that you're looking at that just happens to favor human plus AI. I don't know if you could counter that criticism.
So let me see whether I understand you correctly. You are saying whether our results are driven by the particular time period. Is that what you're saying, or?
Yeah.
Okay. That's a good question. That's also hard to answer because that's the period we're looking at the period of 2000 to 2016. That's basically the period the data available, right? And so it's very hard for us to look at outside that period because we don't have the data. But yeah, that's always a valid point. We are planning to extend our test to a few more years, right? Since we are now into 2021, we have a few more years, and the results are consistent that can confirm our finding.
I think I don't know for others here also a more generative approach. So it's almost like a simulation that could test possible other futures to see if this result holds.
Like simulated data to test. Okay. Yeah, that's a good point. But I guess it's a little bit hard to convince other people, right? Your simulated data is the same data as the real data, right? Because it depends on the underlying model of the simulated data. Huh? So if people buy your simulation process, then probably it's okay.
I wonder, following on that suggestion of the time period dependence, I mean, prior to 2010, I mean, machine learning has really only recently been, well, I'm like assuming it's, if you looked at like the number of AI programs that were available or the number of students that were in these studies, I gotta believe that we've reached a point where they suddenly started taking off, and there's like well, I call it a machine learning race in the analyst firms, right? Everybody suddenly has to have a machine learning program. Everybody is using this in some way, shape, or form. This has happened before on Wall Street. It's not an unusual thing. When there's a new technology, suddenly everybody starts using it, and it may or may not end up really being a differential factor. So I think you have enough data probably to split your sample to sort of say, I mean, you'd have to get a measurement of how much machine learning was going on, say, pre-2010 and then post-2010. I don't know how you would do that, but Reid, would that answer your sort of question about the period dependence?
It might, but I see your point in that this might be the new norm and not having an advantage, right? So yeah, I wouldn't even know how to approach, well, in the ideal, how would one construct a test to show that this is regime independent?
Yeah, I think Larry's point is a good one. Well, I mean, we can split the sample into two halves, right? If without a similar, right? I think qualitatively similar across the two halves, that kind of somehow provides some validation of our result, right? Because it's not bulletproof, but at least alleviate the concern is driven purely by some factor in the second, maybe in the second time period, right, when machine learning is available. And also, I think in the future, people can always extend our analysis in the future, right? When more data available, that's the best test. When you have out of sample data, you can always test the old model with the new data, and if it still holds, that's the best test.
I mean, you do have some very good analysis, those curves where, you know, the advantage is decreasing over time. I mean, that's pretty informative of what's going on. If the measurement errors are, you know, I don't know what the error bands on those things were, but you know, they looked, just using the you know, the old eyeball test, they looked pretty convincing that there was something different going on.
I'd like to jump in going back to the two kind of skeptical points I've raised. One is the analysts, if they are biased optimistically, may be doing what the firms want them to do. In which case it's hardly fair to say that the machines would do better for the firm if that were the case. For example, they might want to do investment banking with some of these big firms. So that's cynical, but I wouldn't totally discount it. The second one is a more serious comment. By comparing the machine to individual analysts, we get part of the picture, but suppose we compared two analysts whose estimates we averaged to the machine. Maybe they would do better. In fact, two analysts would probably do better than one analyst and show a similar picture. And how about four analysts? So when you assume that, for example, that big firms, the machines do better, or the analysts do better, I've forgotten which way it goes. I would want to check and look and see if maybe big firms have more analysts who think alike, or big firms have more analysts who counteract the noisy errors. But I guess that only point is, if you have a chance, take a look at what happens when you combine several analysts and compare them to the machine.
That's actually a really good point. I've heard Andrew Ng talk about the benchmark to beat from a machine learning perspective is really the best that not just necessarily one human could perform, but any group of humans. And he talks about this within the context of healthcare, right? So, teams of doctors trying to solve a particular problem or, whatever, that is the benchmark to beat, not necessarily just one.
And to echo Jared's point, I thought it was very striking the difference between analysts predicting a positive outcome in price and analysts predicting a negative outcome in price. Analysts were far more successful in predicting negative performance than they were at beating the machines on predicting positive performance. And I think that may be a reflection of the optimism and fee generation bias that Jared was referencing.
Good point.
Yeah, those are all very good points. Yeah, thanks a lot. We can think about that. I think currently we focus on individual analysts because we want to see the threat of machine to human jobs, right? We want to relate to that literature. But you think about the threat to jobs, it's just one individual versus the machine. But I totally agree with you. It's a combined. It's an interesting question whether combined wisdom of humans can beat machines or not, right? Human as a race, whether we will be extinguished or not by machines. That's a valid point. But I guess even in that case, there will be, I suspect the result will be, there will be relative advantages and disadvantages of humans and machines, even when you combine all the humans. And there will be still value in combining both of them. Yeah, we can test that.
Can I talk about this? Because I recall that there are some literatures, they are not predicting the future prices, but just predicting the future earnings. And they were trying to compare whether machine can beat the collective of those analysts, like looking at the median consensus or mean consensus among all these analysts. And they find that AI beats machines, AI beats the collective median consensus over some of those literatures. So of course, one of the drawback, as we were talking about, is that they are actually using those median consensus as one of the predictors. So they are actually essentially using some human effect over there. So as Baozhong said, it's interesting to see whether there will be for example, like the collective intellectual effect from those analysts together can have some comparative effect with those AI analysts. So that's something I think is interesting to compare this in the future. Thank you.
Well, one other thought I had was, most quants have upskilled themselves and started to use some aspects of machine learning and AI. So how do we draw the line of, quant versus fundamental, wherein, someone's just basically using, the whole mosaic theory and understanding the markets and understanding the context and making investment decisions versus someone who was a quant and who was already doing, even though we didn't call it machine learning, we were stretching the boundaries of what we could do with quant modeling. And now we have tools wherein you could just basically say, here's X and here's Y, and don't have to do the model specification, right? So that's where we may be kind of leveraging techniques, and now we are saying they're using AI, but in various ways, quants were doing the grunt work of finding the relationships between individual variables and sometimes going to more complex relationships, and the stress testing mechanisms and the various backtesting mechanisms were geared towards doing exhaustive tests to figure out what combination of variables were actually giving the best possible results. So how do we kind of segment out wherein a quant was doing something already, and now they have the additional ability to try more possibilities with machine learning based models?
Yeah, actually, that's a very interesting point. We don't do that here, but I can tell you there's a paper by one of my students and colleague. They are looking at hedge fund performance using the hedge fund AI investment. So what they do is that they measure the number of hedge fund employees who have AI background. Right? They can look at the LinkedIn webpage and see whether those people have AI skills or AI background. And then for each hedge fund, you can calculate how much AI employees they have. And I think their finding is that hedge fund with more AI employees tend to perform better. So I hope that's kind of related to your point, right? Whether they're actively using AI to improve their performance.
Yeah, just to give you a very concrete example, I did a workshop on natural language processing in New York 3 years ago. And we had, I forget the specific, it was like 6 to 8, each one of them having a PhD in statistics or machine learning, all from JP Morgan. And they were tasked to basically look at all the text corpuses they had internally and basically do the parsing and build out models so that you could do information extraction. So they were using AI. They were not in an investment decision-making role, but they were tasked to build a decision support system to augment and assist human analysts to search better, to access information better, to be able to get to what they were looking for in a much faster way. So in some ways they were using AI, but I mean, it was just an information access tool because there wasn't a tool available in the market which was doing that. Probably fast forward 3 years now, I mean, there are tools now wherein you have similar things available as data feeds. And if you are a Bloomberg subscriber or a FactSet subscriber, you probably have access to those feeds, which is just basically, enhancing the way you do research, but you're using AI not as an investment decision process in the investment model itself, but as a decision support system.
Okay, yeah, that's a very good point. Yeah, I think that actually could be the mechanism that's happening in our results, right? Because the AIs are not actually making the prediction for the analysts, but they're providing support, right? As you said, to the analysts.
Right.
Yeah.
Right. And I mean, it could be a more generalizable approach to say, instead of an actual financial analyst making a decision based on the model versus, an organization which is using data-driven methodologies and AI-driven methodologies versus an organization which is only using traditional methodologies, right? So there, the analysts are predominantly using, fundamental analysis and various traditional investment methodologies versus an organization which is using data-driven and enhance models to do investment decision making.
Yeah, if we can get some data like that, if the analysts disclose that in their report, then we can do some tests on that.
Right. Yeah. Yeah, and again, that's a fascinating area, right? In terms of manager performance analysis and performance attribution, how much was it just an analyst basically putting things together and the numbers were already crunched for them and making decisions versus they basically came up with a combination of different data points to actually make that investment decision. So how do you do attribution in those cases wherein you had multiple alternative data feeds and you basically made a decision based on those feeds versus you actually built out your thesis and you made the investment decision based on those.
Yeah, I totally agree. This will be very interesting to know. If we have more data, more knowledge about the details of the decision-making process, that would be cool. Okay, I think we are run out of time, but basically, I'm basically done. We confirm our hypothesis, right? AI hiring actually does help the analysts to become better, and especially after the alternative data become available. So to conclude, what's the takeaway of our paper? So first of all, we compare AI with humans and see AI have advantage when the firm is more complex, has more the information is high dimensional and transparent. Human analysis actually is more competitive when the information requires institutional knowledge or when the situation is unusual. But the edge of AI over human actually decline over time because the analysts are having access to AI resources and big data. And combining human and AI is probably the way to go in the future, to generate more accurate forecasts and for the industry to survive. Thank you.
I had two technical suggestions. One is, at some point you said you were doing transformation to mitigate the skewness. I would not ever mitigate skewness. Skewness is an extremely valuable variable to take advantage of. And if you include it, you could probably find that there's a lot of information in the skew, and the tail is very important. I know sometimes people just say, "Oh, you should normalize everything," but no, that's not really a good idea. The second thing is there are techniques to combine higher frequency data with lower frequency data. There's sometimes they're called state space models or Kalman filter. There's a guy, Frank Diebold, who's did this for real-time predictions of the market, and it is really a valuable technique. It allows you to combine stuff that has different frequencies, and you don't have to worry about reducing everything to one higher frequency or one lower frequency. So you might just look at that as a suggestion.
Yeah, thanks a lot for the suggestion. But by the way, for the high frequency, low frequency, is it possible to do it in machine learning model, or is it a general technique?
It is a general technique. The Kalman filter state space models can use anything. I mean, I've used them with combining daily data with quarterly data. So you can have daily observations, like you have the T-bill rates, or you had daily observations, and then you had quarterly or even semi-annual. The model works by using whatever data is available at the moment, at that point in time. So if you will, the kind of the matrix expands and contracts depending upon the new information that comes in. And you're extracting from every iteration, if you will, every new piece of information you have in, extracting the maximum amount that you can get from that. And so you're not throwing away all the information that comes in on a higher frequency basis. So,
Okay. So, yeah, we'll look into that. Thanks a lot.
Yep.
Thank you so much.
Yeah, one thought I had was, in a student setting, it could be something you could try out, maybe something at the BCF2U. So if you can create like an A/B test, wherein one group of student analysts, assuming that all the students in that cohort have similar skills. So one cohort, half of the students will be having access to all machine learning tools with the same data set, all tools, and another half having only traditional tools. and then set up a paper portfolio and see for a particular duration, like, who's going to do better, and can you attribute it to the tooling and the data they had versus their analysis skills. Just a test setting. It will be interesting to see.
Yeah, that's very interesting. Yeah, thanks so much.
Shri, I think in order to not get students frustrated, you want to make sure that the students have a chance to be both the informed and the uninformed at some point in doing their experiments, so they both can get the experience. In fact, you probably have to do 4 experiments where you were giving them the right information, they were right. You're giving them the wrong information, wrong. You know what I mean? The 2x2 matrix.
Yeah, it's hard to structure the tests.
Yeah.
I mean, when I was having an experimental surgery a few years ago, and one option was a physical therapy and another option was a surgery. And when I went in, the doctor was very pleased because he was looking for a patient to do surgery. And he did a randomized test and he basically selected me for the surgery group. So he was, and I don't know whether it was an A/B test, he did it honestly, or he just put me into that group. But yeah, it's hard to kind of, make students split them into groups. But yeah, it's a good point. Maybe you could do it in 2 semesters. One semester, have them, and then switch them, and then see what their feedback is. Did they think they did better because of tools versus they not having the tools?
Yeah, you can do it week by week. Every week is a new experiment. So give them lots of chances to be right or wrong, I guess.
Give one portfolio of Dogecoin and Bitcoin, and another portfolio of some traditional boring industry sector, and then see who performs better.
Maybe I should do that in my next class. Try to. I'm teaching a fintech class, so maybe I can ask them to do that. Thanks.
Yeah, this is very helpful. Thank you for sharing your work. So Bozang, if you have any code or data, we'd be happy to post it. We have a sandbox, and we've done it for a couple of sessions. So if you have anything, please let us know. We can put that, and people can try it out themselves too. Any Python or R code, or even MATLAB code.
Yeah. Okay. We'll do that. If we have additional research in the future, we'll also share with you.
Absolutely.
Yeah.
Yes. Thanks so much. Your feedback has been very, very helpful.
Bozang and Junbo, thank you very much for presenting.
Thank you.
Bravo.
Thank you.
Thank you.
So have a good night.
Makes me feel good.
Hugh, is next month's session online, or we're getting back in person?
I don't know. I gave Jared the option of doing it on a Zoom or at the Tennis and Racket Club.
If you get the Racket Club open, I would show up there.
All right. Okay. Good.
Okay, so I just give me a little bit of advance notice because I got a plan coming down there. If we're doing it in person.
Okay. Yeah. I'm going to Denver for a wedding. So I'll keep you posted.
Dan, what do you think?
The club has been open generally.